Good morning, everyone. Thank you so much for joining us for today's webinar. I'm Simran and I work with Tally Solutions for the Middle East region, and I will be your host for today. As you all know, the news of UAE corporate tax is one of the biggest news after VAT. On 9th December, the business profits will be applicable from 1st June 2023, and most businesses will become subject to the UAE corporate tax. We understand that you will be eager to know more about this compliance norm and its impact on your businesses. So let me just set some ground rules before we get started to ensure a flawless experience for everyone. All the participants will remain on mute throughout the session to avoid any noise and disturbances. Please be informed that we are recording this session and it will be available as an on-demand webinar later. I apologize in advance for any network interruptions that may occur. However, we will try our best to make this experience seamless. I'm sure you would have a lot of questions during this discussion, so please type them in the question box of your Zoom control panel and we'll bring them up towards the end. Now, today we have many eminent personalities with us who have got profound knowledge about taxation. So let's get started. Let me first invite and introduce CA Yogesh Thar, who will take us through the session. Mr. Yogesh Thar is currently a partner of BANSI S, METHA CO, a leading firm of chartered accountants in Mumbai. He's a fellow member of the Institute of the Chartered Accountants of India, and in his work experience of 38 years, he has acquired a specialization in the areas of corporate taxation of non-residents and foreign companies, business mergers, acquisitions, and restructuring. Mr. Thar has served a number of committees constituted by the Honorable Bombay High Court in 2014 in relation to a major commodity market scam in the country. Mr. Thar also has experience of serving as an independent director on board of public listed companies. He also has served as a member of the managing committee of ITAT Bar Association, Mumbai. Mr. Thar is presently a member of the taxation committee of the Chamber of Tax Consultants. Next, let me introduce CA Janak Panjwani, who is a qualified chartered accountant and has been in Dubai for the past 30 years. He is currently the director in PUTHRAN Chartered Accountants and possesses knowledge, technical skills, and professional know-how in the field of auditing, VAT, ESR, transfer pricing, and international taxation. He has a keen understanding of several aspects of international financial reporting standards and serves as treasurer of the Indian Business Professional Council, that is IBPC Dubai. He's also the committee member of Dubai chapter of ICAI, office bearer of various committees of Bombay Chartered Accountant Society, joint governor of Study Circle Committee of the chapter, and as the election office of Dubai chapter of ICAI. CA Janak has been a speaker at many professional conferences and written articles in professional journals. So over to you, Mr. Yogesh.
Yeah. Thank you, Simran. And thanks to the entire Tally team for giving us an opportunity to, actually study the UAE law and get into the day-to-day issues that may crop up when the UAE implements the new tax regime, the new UAE corporate tax law. I also thank my dear friend CA Janak Panjwani and Mr. Rajiv Hira, with whom my firm has been associated as you may call a knowledge partner, and we have been sharing our knowledge and experiences with each other ever since the UAE tax law has been enacted. I welcome all the participants who I understand are part of the business community in the UAE and are really eager to know what is there in store for all of us. In the UAE law, which kicks in the month of June 2023. So here we are in the first 1 hour. I have to cover up the topics related to transfer pricing, which really relates to the transactions with related parties or connected persons. That is one topic, and the other topic which I'm asked to, which I'll be covering is what is known as GAR, General Anti-Avoidance, regulations. Now, what really is this transactions with related parties? What is this topic about? It is about the transactions with related parties and connected persons. Now, why is this topic really important from the tax perspective? One can ask a question. Why is the taxman really concerned about only my transactions with the related parties? And the answer to that really is that so long as I pay my due taxes, the government is really not concerned, the authority is not really concerned. So what they are concerned is that I pay my due taxes, and therefore there are specific provisions made for dealing with the transactions with related parties. Now, what do you mean by this? What the tax authority wants is that you arrange your affairs in such a manner with your related parties and your connected persons such that there is no artificial shift of profit from one taxable person to another person, or from a taxable person to a non-taxable or an exempt person, or from a taxable person in UAE to a person who is not taxable in UAE because he's a non-resident of foreign company, and so on and so forth. And therefore, when I arrange those transactions between the parties who are really related or connected with each other, I have to organize my transfer price, the price at which I sell or buy goods or services. That transfer price should be what they call as an arm's length. Now, this is where, and if it is not an arm's length, the tax authority will have a power to compute your profits based on the arm's length rule. Now, this is the whole topic, and this is the importance of the topic that we are going to deal with. This particular subject of transfer pricing is, spread by and large, is spread over various provisions of the UAE tax law, the decree law. And, you have Article 1 where we have definitions of related party, connected persons, and market value. Here at this stage, I may just clarify, why do I have these two concepts of related party and a concept of connected persons? Why can it not be one? This is what I have been wondering, and I've been debating with my friends in the UAE as to why these two are there. So if one goes through the public, comments, document, where a public consultation document, which was announced in 2022, one finds that a connected person is a wider definition. What is intended, they intend to cover certain people who are not strictly covered within the related parties, and it is possible for a company to arrange its affairs in such a manner that because there is no personal tax law in the UAE, okay, then a business may probably pay more to its owner, in terms of management fees or whatever, and that payment of a more amount may erode the tax base of that taxable person. So therefore, therefore there's something which is going out from a taxable person to a non-taxable individual, a natural person, and that is why there are certain payments which are specifically disallowed in the hands of the company which makes payments to a corporate, which makes payment to a connected person. And that is why you have these two concepts. But I felt that, it could have been combined in one, but nonetheless, this is what the law today we have, and we are going to quickly, in first 45 minutes, deal with these topics. Then there is this chapter 10, which actually lays down, which is the heart of this whole thing, Article 34, 35, 36, which lays down this arm's length principle. Then there's a provision in Article 55, which deals with documentation. Then you have certain transitional rules, where are very interesting rules. We will go through that your opening balance sheet should be based on arm's length principle. What does it really mean? Then there are certain provisions where certain persons who are exempt, if they have transactions between their exempt business and non-exempt business, that also should be at arm's length, because there's a shifting of profit from an exempt or from a non-exempt business to an exempt business that is not permissible. And finally, you have a provision of limitation of interest expenditure on loans from related parties. These are the provisions which actually contain this entire law relating to transfer pricing in the decree law 47. So what is this arm's length principle? We just need to understand that one more structure of the decree law, of the tax law in the UAE. You have what is known as the decree law. Then this decree law provides the power to the cabinet to to prescribe something or to give a particular decision, it gives power to the minister under certain provisions, and it gives power to the authority under certain conditions. And therefore, apart from what is written in the decree law, the pursuant to the powers given to the cabinet, to the minister, and to the authority, these decisions will come in, as and when the law progresses. And those decisions will also have the authority of the law because of the specific power granted under the decree law itself. So this is how the law is structured. And therefore, now you have this particular provision in Article 34, which deals with arm's length principle. So what does it essentially say? It says that a transaction and arrangement between related parties must meet the arm's length standard specified in this article and conditions that may be prescribed in a decision issued by the authority. So everything the lawmaker has not been able to put in today in the law itself, in the decree law itself, and therefore certain conditions which may be prescribed by the authority over a period of time will also have to be satisfied. And therefore one will have to keep track of all the decisions that are issued by the authority from time to time. Now, they have defined what is a related party, and the related party essentially is any person associated with a taxable person as determined under Article 35(1). Now, what is this Article 35(1)? We'll just see in a moment. So now it says any person. So mind well, any person would be a natural person or a juridical person. It may be a resident or it may be a non-resident. He may be a person whether he's a taxable in UAE or is not taxable in the UAE. So any person can be a related party associated with a taxable person in the manner determined under 35(1). Now, what is this 35(1)? 35(1) essentially is it lays down various criteria to determine who is a related person. Now, this particular definition uses the terms means, and therefore it is an exhaustive definition. You cannot add anything more into it. So 35(1) says that related party means so and so, so and so, so and so. Now it talks about a situation of two or more natural persons. So they are saying two or more natural persons will be related party if they are related within fourth degree of kinship and affiliation. Now, fourth degrees of kinship and affiliation, as I understand from my limited knowledge of the UAE law, is the first degree is spouse, parents, and children. Second degree is the siblings, brothers, sisters. Third degree is the uncle, aunt, and the nephews and nieces. And the fourth degree are the cousins who are actually children of the two brothers or two brother sisters. So these are the people who are related within the fourth degree of kinship or affiliation are related within the meaning of this particular provision. So transaction between these two. Then for a natural person and a juridical person, so an individual and a company, there they have basically two broad tests. One is a 50% ownership test, and the other is that a natural person controls directly or indirectly, either by himself or along with a related party. So Mr. A and his brother, two put together, or Mr. A and his two brothers, three put together, control a particular entity. Then neither of them will own 50% on their own, but they would control the entity, all three of them by self, and all three of them put together will own more than 50% of ownership. So there can be situations where there can be control without even the ownership. And those are situations where we know that, say, for example, you have entered into an agreement with a lender, where to a lender you give control of your business under certain circumstances. You're unable to pay his debts, etc., and he gets control over the businesses. So therefore, in such a situation, you can have a lender or a person who is, say, for example, a person who is owning to whom you have issued preference shares or a convertible instrument. Those are the so you may have control given to somebody else other than the owner of equity under various situations in real life business. So therefore, they are covering both the situation: 50% of ownership or a person who controls a company. Then you can have situation of two or more juridical persons. So we're talking of company A and company D. When these two can be regarded as related parties, same test: 50% ownership or control by one of the other, or one individual or set of individuals are controlling both these companies, or one company is controlling both the companies, then these two, both the companies which are controlled, or who has 50%, person who has 50% ownership in company A, 50% ownership in company B, then A and B both would be regarded as related parties. So this is so far as two juridical person or two companies are concerned. Then a person and his permanent establishment, PE stands for permanent establishment, or a foreign permanent establishment of a UAE person can be regarded as related parties. So a non-resident of UAE and its permanent establishment in UAE are related parties. So transaction between a UAE branch of, say, an Indian company would be a transaction which will fall within the purview of transfer pricing, because they are related. Although they are not two different persons, for the purposes of the UAE law, they will be considered as related parties, and therefore these transactions between the UAE branch and the Indian company will have to be on arm's length. Similarly, a UAE resident and its foreign PE, foreign permanent establishment, that also will have is regarded as a related party. However, so far as a UAE resident is concerned, for a UAE resident, a global income is charged to tax, and therefore its global income will be included in his tax, and the tax which he pays in the foreign country on his branch you may get it as a tax credit. So therefore it may not be very vital from the point of view of transfer pricing, but nonetheless the relationship is that of a related person. Then partners of an unincorporated partnership are related persons. Then when it comes to a trust, you essentially have a founder or a settler of a trust, a trustee of a trust, and you have a beneficiary of a trust. These are the people who are considered to be related parties. Now, we saw that it's not just the ownership, but also control. And therefore, this is a term which is a simple English term. What does it mean when it comes to interpreting it in law? When can I say that I'm controlling? When can I say that I'm not controlling? Is it subjective, or are there any objective tests for this? So there is a definition which says that control means the ability of a person to influence another person. Now, ability can be either in his own rights, because I'm the owner, I can control, or by an agreement, as I said, agreement with a lender, agreement with someone to whom you have issued a convertible instrument, or otherwise. Or otherwise is extremely wide, which situations which you cannot really think of at the time you are enacting the law. But under any business situation, if you have given a control to any entity, suppose somebody has financed you for your entire plant, or somebody is providing you with his entire plant, okay, and that it is on that plant or on that technology you are conducting the business, and therefore certain controls of your business you have given to him. So it's very, very wide. So therefore control is an effective de facto control that one has given. So person's ability to influence another person, very, very simple definition given in the law, and therefore we'll have to think from that point of view. It clarifies a bit that control includes 50% of voting rights, determine composition of 50% of board of directors, 50% of profit share, and exercise significant influence over the conduct of business. So therefore, there may be situations where I have 50% of voting rights, but I'm not the owner of 50% of shares. So there will be shares with differential voting rights. There can be shares with differential profit sharing ratio. I have 50% ownership rights, but I do not have 50% profit share. I only have voting rights. So whether 50% of profit share or 50% of voting rights or both, everything would come within the definition of control, and the ability to determine composition of 50% of board. And then it talks of significant influence. Now, this is a term, once again, which is not defined in the law, and therefore it raises some sort of ambiguous situations when it comes to interpreting what do you mean by significant influence. Interestingly, this particular term we find in IFRS, which is the accounting standard by and large, which is followed in the UAE, and IFRS really defines this. It also has this concept of control, and it also has this concept of significant influence. And interestingly, you have a provision over there which says that 20% of ownership is a criteria to a presumption is raised that the person who owns 20% of ownership can have a significant influence over the person. Now, so therefore, there is a dichotomy. There you're talking of 20%, you're talking of 50%. And therefore, what will prevail? Answer is very clear that the decree law will prevail. Even though IFRS says significant influence can be of 20%, I would personally feel that the decree law will prevail because it talks of 50%. Nonetheless, significant influence does not stop over there. It essentially talks about participation in the financial or operational policies or decision making. So if you are in a situation where you are participating in the operational policies or the decision making of an entity, then probably you have a significant influence over the conduct of the business. And this is somewhat in line with the international treaty definition of a related party. In the treaties, what they call it as associated enterprise and not at related parties. And there they say that a person who is an associated enterprise if he participates in management, control, and capital of an enterprise. So participation in management, control, and capital will give rise to significant influence. So as you will observe, friends, these are overlapping concepts. And what therefore one is to see is not just a share ownership, but whether I'm able to participate in the policy making or the decision making. Is there any material transactions which the other party has undertaken with me such that he gets a material, he gets certain powers to influence my business decisions, and I cannot do something because I'm contractually bound. I cannot do this, I cannot do that. I have to give him his profits first. I have to give him his interest first, and so on and so forth. So these are the aspects which will determine control. Indeed, it's somewhat subjective, but if one looks at it objectively, if one looks at it from the point of view of compliance with the substance rather than the form, and I'm sure Janak Bhai will be covering and Rajiv ji will be covering what is substance versus form in when they deal with it. That is where the significant influence concept may have to be really applied. Now, having said that there is a related party, what is this arm's length standards? And the law provides that your transaction between related parties must meet arm's length standard. Now, what is this arm's length standard? Arm's length standard is the result that would have been realized if persons who are not related had engaged in similar transactions under similar circumstances. Most important, not unrelated parties, similar transaction, similar circumstances. I've underlined these three words, and therefore this needs to be noted. This will come up again and again, and immediately in the next article, Article 34.3, where you says, okay, the 34.2 says that arm's length standard is this. So as if the transactions are between unrelated parties who would have entered into a similar transaction under similar circumstances, what would be the charge, what would be the profits earned by both of them. These are the arm's length standard. So now the question is, how do I determine? How do I actually determine these arm's length standards? So the law provides certain methods. The law provides methods which are actually coming from the OECD, and which are the methods which are even adopted in India and many parts of the world where transfer pricing is there. And there are 5 essential methods, and the 6th one is a residual method: comparable uncontrolled price method, resale price method, cost plus method, transactional net margin method, profit split method. And then that residual is that if none of the methods can be reasonably applied, then you apply any method to meet the arm's length. So that's a residual method. Now, what is this? I'll just take 2 or 3 minutes to quickly run through these. Comparable uncontrolled price means I have done a transaction with an unrelated party, sold certain goods. I have done a transaction of similar sale to my related party. So there is a price which I have charged to an unrelated party. There's a price which I have charged to a related party. Now, if those transactions can be regarded as similar transactions under similar circumstances, then the price of that two transactions can be compared. And if I have sold to my related party at a price lower than the price at which I sell to the unrelated party, then there can be probably an addition. But in the sense that there can be some sort of a tax addition made by the assessing authorities. So comparable uncontrolled price actually compares the prices of the commodities sold or purchased between the related parties. That is the price method. Then you have a resale price method. Resale price essentially says that, look, I buy from a related party and I resell it to a third party. Now, when I buy from a related party and resell it to a third party, I may earn certain margin. Suppose I earn a 10% margin. Now, there would be a situation where I buy from unrelated party and also sell to unrelated party. In that transaction, I earn a margin of, say, 12%. So then the law says that, look, boss, you have purchased from a related party and you are earning a 10% margin. You have purchased from an unrelated party and you have made a 12% margin. So it implies that your purchase from your related party has a higher price. And therefore, the law will have a right to adjust your profits to that extent. So under what circumstances the resale price method can be applied is a topic by itself. At this point of time, it's too premature to get into it. Then the third method is a cost plus method. What it actually means is a cost plus means that I'm manufacturing something and selling to a related party. And I'm manufacturing something and selling to an unrelated party. Now, in the transaction with a related party, I earn a margin of 10%. And in a transaction with an unrelated party, I earn a margin of cost plus 12%. So there the law will say that, look, you are earning more than more from an unrelated party than from a related party. And therefore, the price at which you are selling is underquoted. And therefore, I will make an upward adjustments towards your profit. So this is cost plus method. Once again, under what circumstances, it's a topic by itself. At this point of time, we're not getting it. Then you have transactional net margin method, essentially, which is something which is very widely used because it's very difficult to get comparable uncontrolled prices, means two and third party dealing with the same product. Difficult to get that data in public domain all the time. Resale price, unless you have that data within yourself, a resale price of an outsider, very difficult to get it in public domain. Cost plus, once again, unless you have internal data, to get it externally is very difficult. So at times where the above first three methods are not practical to be applied, then a fallback is this transactional net margin method. And what does it really say? It really says that what is the profit that you are earning? I'm earning a profit as a percentage to, say, cost, or as a percentage to selling price, whatever you look at. I am earning a profit of 10% net margin in my business. Now, what are the companies which are similarly placed as mine? Those companies who are similarly placed as mine in this economy, what are their margins? And then I have a complete data list from the publicly available databases that look at the profits of each of these companies who are similarly placed as mine and what are the margins they earn. And then it will give you a range of margins. And if your profitability falls within that range, then fine, you are from a transactional net margin method, that is TNNM method popularly known, your margins are fine. We will accept it, and there is no upward adjustment required to your taxable income. So that is essentially the transactional net margin method. And finally, you have a profit split method where essentially you are doing businesses within, by and large, within your group. Somebody owns an IPR, somebody is using that IPR for manufacturing, and somebody is selling that product in the market. So the companies which are all related are related in such a manner that the transactions are made, which are not really, they are really part of the same transaction of owning the IPR to manufacturing, to distributing, to selling, it is constituting as such a one whole business, but you split it into various entities, in which case this profit split method says that you have to look at the profits which everyone is earning in totality and split that profit amongst various entities in a manner which is acceptable under this particular method. So there are various nuances of profit split method. At this point of time, we will not get into it. So these, friends, are by and large the 5 methods. And the 6th one is a residual method. And residual method is nothing applies. So what applies? Where there can be so many things, like say, for example, you get a quotation from somewhere, or more prevalent are the cases of valuations. I do a valuation of say, for example, corporate guarantee. I've given a corporate guarantee to somebody in my own company, in my own group, and that is the value which I'm giving it to him, and therefore I should be charging. If a banker would have given a corporate guarantee or a guarantee, he would have charged some commission, then therefore I should charge some commission. So what is the fair value at which this is done? Again, if suppose I'm selling certain assets, so what is the fair value at which those assets, or suppose I'm using an IPR and therefore paying a royalty, whether I'm paying a royalty is arm's length or not, 5% royalty or 2% royalty, what is arm's length, which will actually depend upon what is the value of that brand or what is the value of that IP, and then whether this 2% is considered as arm's length or not. So once again, you get into a technicalities of valuation. We may probably have some time in the question answer session towards the end, where we have my partner Drusti Desai also participating here, and she's a valuation expert, and maybe she may throw some light on these aspects of valuation of things like corporate guarantees and things like royalties and so on and so forth. So that, as I said, is a residual method. Now, friends, what the law says is that from all these methods, you have to choose what they call it as most reliable or most appropriate method. And what are the factors that should go in deciding which is the most appropriate method? Of course, the first and foremost is the availability of the data in the public domain. That is the most important. But then, assuming the data is available, whether in public domain or privately or whatever, then what are the contractual terms? So I cannot compare a transaction which is based on a 90 days credit with a transaction where I require an advance payment. There will definitely be some difference. If at all I am able to compare it, to that extent, I need to make an adjustment to make them comparable. So contractual terms, characteristics. So I can't compare oranges and lemon. So the products will have to be similarity if I have to apply a CUP, comparable uncontrolled price method. So characteristics of the transaction or of the products. Economic circumstances. So I'm dealing with country X, which is highly developed country. I'm dealing with country Y, which is not a very developed country. And therefore, economic circumstances in these two countries are completely different. Even within UAE, you may be dealing with a free zone as entity and a non-free zone, mainland entity. Then those economic circumstances in that case are also slightly different, because they enjoy different advantages in terms of, because they are located different. So economic circumstances. Then if FAR analysis, one of the most important thing in your entire transfer pricing is the FAR analysis. That means functions performed, assets employed, and risk assumed. So say, for example, I am selling my goods to a stockist, and I'm also selling my goods to a retailer. So if the third party to whom I'm selling is a stockist and the related party to whom I'm selling is a retailer, two prices cannot be the same, because when I'm selling it to the stockist, he in turn will sell to the retailers in his jurisdiction, and therefore the price to a stockist and price to a retailer cannot be the same. So therefore, the functions performed by these people have to be seen to make them comparable. Then say, for example, you are applying this profitability method, transactional net margin method, where you look at the profits of various companies which are similar to you. Then Then I do a FAR analysis to see what is the business model. I am a manufacturer who is selling to third parties, and I have my own brand which I am selling, and therefore I am making a particular level of profit. There may be another company who is producing a similar product, or it's in similar business, but he is not manufacturing his own product. He is manufacturing for somebody else. He's only doing a job work. So obviously a job worker's profits will be much lower than the profits of a person who is doing his own sale. And therefore, the functions employed, functions carried out by these two entities may look same, but what their risks profiles are different, because one owns an IPR, the other doesn't own an IPR. So therefore, friends, this FAR analysis becomes an important factor in deciding your methods and how do you apply the transfer pricing methodologies. Business strategies employed. So I may be adopting a practice of penetrating into one market, and therefore I want to push my goods, and therefore I'll sell at a lower price in one place, and in the other place it's an established market, and therefore I'll get a premium because I'm already established over there. So the business strategies. So merely because the prices are different, it does not really mean that an adjustment has to be made. It really depends upon the business strategies that one adopts. So based on all these factors, one has to look at what is the most appropriate method, select a method, and then go about doing this entire transfer pricing adjustment. These are the provisions. We need not get into great detail of this. What is important to know is that there can be a range concept which the authorities may specify, that which is as of now not specified. In India, you have a range concept where you say that if you have got 100 different comparables, then a range of 35 to 65 percentile, so long as you are within that range, we will consider you at arm's length. So something similar may come up. They're talking about the results to be within the range that is acceptable. And if it is within the range, then that an adjustment cannot be made. What important aspect is that we have in the UAE law that a corresponding adjustment will be made. So suppose two parties within the UAE, both are taxable entities, and an upward adjustment is made in the hands of one related party with a transaction with another related party. The law says that the tax authorities will make a corresponding adjustment in the other related party, in the sense that to him a downward adjustment will be made. Now, so long as they are both taxable, it may be tax neutral, but one is taxable, one is not. Then that downward adjustment in the hands of the other really does not matter, because you have paid lower taxes in one where the adjustment is made, and you are not paying the taxes in the other case, which is not taxable entity. So these are the provisions. Then you have this provision of connected persons. And there we are told that a connected person, again, is a person who is affiliated with a taxable person in a manner which is once again specified in 36(2). And what are these? So it includes an owner. Now, the owner is not necessarily 50% owner here. Even a 1% owner is an owner in law. But I presume that there may be some clarification under the decree law, where under the clarifications to be issued either by the authority or by the ministry, where they may specify the percentage. Because if you say that 0.001% owner is also connected person, I am not too sure whether that's the intention of the legislature. But nonetheless, it's an owner of a taxable person is connected person, a director or officer. So one director cannot make a difference unless and until the majority takes a decision. A decision may not be made by one director, but yet, therefore, he may not be a related party. But he is still a director who is a connected person, and therefore, any payment to a director will be governed by this. An officer may be just a mere employee, yet he would be regarded as a taxable person, as a connected person of a taxable person, or any related parties of these directors or officers or the owners will all be regarded as connected person. And what it clarifies is an owner is a natural person who owns an ownership or who controls. So once again, ownership as well as control, both the aspects are there. partners of an unincorporated partnership is also covered as a connected person. And you have, and what the law really says is that there are certain payments which are made to the related or connected persons will be disallowed if those payments exceed the market value of the service or a benefit which is provided. So service or a benefit or otherwise. So or otherwise is very wide, and therefore it may be service or a benefit. It may be also sale of goods. It may be sale of IPRs. It may be sale of service. It may be sale of tangibles, intangibles, movable, immovable. Everything would really get covered within or otherwise. So what it says is if it doesn't correspond to market value. What is market value? Market value is arm's length price. What is arm's length price? As determined in Article 34, we saw this 5-6 different methods. And so long as you are compliant with those methods, we will not make any adjustment. But if the payment to a connected person is more than the arm's length price as determined by these various methods, then it may attract a disallowance in the hands of the payer. And there are certain exemptions which are given that no, we will not disallow in case of listed companies. We will not disallow in case of regulated entities. And basically the reason is the listed entity is governed by corporate governance rules and regulations. And if there is anything which is beyond the, beyond the arm's length limit, the corporate governance itself will require that to be qualified in the accounts. So a listed entity, a regulated entity, and other persons as may be determined in a decision issued by the cabinet. So going forward, if there is some entities or some persons who are in genuine difficulties, probably they may be notified by the cabinet. Now, having got this broad idea, what is the sort of documentation that will be required? We have the section 55, Article 55, it talks of transfer pricing documentation, and I will be required to file certain information with my return of income. It essentially talks about two broad categories of information, a master file and a local file. And what does this mean? A master file is something which is at the group level. It provides a group overview. It provides the organizational structure. It provides the geographic operations and geographic locations where you and your related parties are located. The main value drivers or the principal profit drivers of the entire group. The description of the businesses which every entity carries on. What is the transfer pricing policy adopted by the group as a whole? These are global level information, which is called as master file. And you have local files. Local files would essentially mean, your local management, your local companies with whom you are carrying out transactions. The intercompany agreements, or even the transactions which are carried out with international, related parties, then their agreements, their details. What is the transfer pricing methodologies that you have followed? What is the, what are the financials of the comparable companies, or what are the data of the comparables that you have with which you are compared? So these are the aspects that you will have to maintain documents in respect of, so as to to comply with the transfer pricing documentation under the law. So I have given certain practical hints: ownership structure, profile of the MNC group, terms of understanding of the agreement, functions performed, assets employed, economic and market analysis, minutes and correspondence of negotiations, critical aspects affecting the pricing, record of comparable transactions, data used for working done. You do your arm's length pricing working, so you keep those workings, etc. Details of adjustments, if you have done a credit period adjustment, a working capital adjustment, a quality difference adjustment, quantity difference adjustments, all those things will go into the workings. Then financial statements of comparable companies, screenshots of the database that you have used. So you have several databases available, for comparison of companies, giving the data of companies, and whatever database you use for comparisons, please keep those screenshots, please keep those in your archive, so that at the time when the tax audit comes up or the tax authorities want you to explain certain things, it will be available with you. If you don't maintain those documentation, then first of all, you are violating Article 55, and secondly, justifying your price after 2 years, 3 years, 5 years, 7 years, because you are required to maintain this data for 7 years, and within the 7-year period, if the authorities takes up your tax audit, then it will be your duty to give the documents. If you don't prepare it upfront, then at that point of time it will be difficult for you to really compile those documents. Then you have a very interesting provision in Article 61, which talks of a transitional provision, which essentially says that what? It says that your opening balance sheet for the first taxable period. Now, first taxable period will be the taxable period which starts after 1st of June 2023. So say, for example, you're following a calendar year, your first taxable period will start on 1st of January 2024. So your opening balance sheet of that first period will be the closing balance sheet of the earlier period. 31st December 2023 will be your opening balance sheet. It's a common sense. Why do you need all these provisions? So that is what they have said. However, you need these provisions because they go ahead and say that the opening balance sheet will have to be prepared taking into consideration the arm's length principle in accordance with Article 34. Now, what does that mean? Till last year, this tax law, decree law was not there. So I was not following transfer pricing. I was doing my transaction with related parties at whatever price I wanted to do. And based on that, my December 23 balance sheet has been made. Now you are telling me that, look, your 1st January balance sheet, you will have to make sure that the 31st December balance sheet is adjusted on the basis of the transfer pricing under Article 34. What does it mean and why is it required? It really means that all the assets and liabilities in the opening balance sheet are to be recorded as if the past transaction with related parties and with connected persons were undertaken with arm's length price. So why? Why is it received? What are the implications? Why is it really required? The question is important because the income of the taxable period, a tax period is to be taxed. What is a tax period? Tax period is a financial year. What is a financial year? It can be calendar year or whatever year I follow. And as I said, the decree law shall apply only to tax periods commencing on or after 1st June 23. And therefore, the earlier periods, there is no decree law applicable. So why is it really necessary for me to make? I can understand that there is a provision in the decree law to allow me carry forward losses. So if I've incurred a loss in year 1, then there are provisions to say that that first year loss can be adjusted against the second year's profits to a certain extent. But they also say that the losses which are incurred prior to the first year, that is prior to the 1st June 23 cutoff date, those losses we will not allow you to carry forward. So if those losses are not allowed to be carried forward, why should I compute my profits for the past year on an arm's length basis? And what is really the essential? Why is it so essential? So friends, answer lies in this, that what you are required to do is to compute your balance sheet on arm's length basis. Therefore, all your assets and liabilities on the closing of the last year should be on arm's length basis. So what is the impact of that? So suppose there is a sundry debtor which is sitting in your closing balance sheet. That sundry debtor ultimately does not get realized. Or you have a sundry creditor in your balance sheet, which is a related party, and you somehow at a future point of time, you waive off that creditor waives you off, and therefore you don't have to pay that related party for the purchases you had made. And therefore, in the coming years, in the taxable years, you either write off that as a bad debt or you write back that creditor and offer it to a profit and loss account. So that will have an impact on your future profits. Now, when the law says that your opening balance sheet should be arm's length, would mean that your debtors and your creditors sitting in your closing balance sheet of last year, they should be on arm's length, because when we will allow you those bad debts in the future, or when we will tax you on that right back in the future, then that should be an arm's length only. So suppose you have paid low for the goods that you have purchased, or suppose you have paid high for the goods that you have purchased, now you are writing back. Then what we will tax you is on a higher or a lower amount, as the case may be, applying the transfer pricing provision. So arm's length requirement for the opening balance sheet will have impact only in the future years' taxability when it comes to claim of bad debts of the past years, when it comes to computation of a credit of your write back of the creditors, or suppose you have bought inventory from your related parties, and that inventory is lying in stock on the last balance sheet day. That inventory should be on an arm's length basis, because the profits which will be taxed in the year in which you sell it, those profits will be only those profits which are over and above the arm's length, not profits which are so if you purchase an inventory for a very throwaway price, so something which is worth 100 you had purchased for say 80, and in your first year of taxation you sell it at 110, then what will be taxed is 80 minus 10. Even though your book profits is going to be 10, it will be 110 minus 80. The 30 will be taxed in the year of taxation, and not just because you had not purchased an arm's length basis. So inventory carrying cost is not an arm's length. You make it an arm's length, that 100 should become 80, and next year when you sell it at 110, we will tax you on 30. So that is these are the implications of having your opening balance sheet at arm's length. And therefore, friends, this exercise will have to be done today to bring your opening balance sheet on an arm's length basis. And once you do the exercise today and keep your documentation to show that my inventory, my debtors, my creditors, my PPE, the property plant equipment, which I have acquired from my associated or from my related parties, they are all on arm's length basis. And therefore, all those transactions which are either on asset side or liability side of my balance sheet, which relates to my transaction with my related parties, those will have to be on an arm's length basis. So that exercise will have to be done now, so that in future, if you are selling your plant and machinery, if you are selling some assets which you had acquired from a related party, the gains will be computed based on the arm's length price and not on the price at which you actually purchased. So this is the significance of this whole thing, which is actually not it's not if somebody says that this is retrospective and therefore you may have to pay taxes of the past years, that is not right. That is not really relevant. Why they are asking you to do is because the future profits will depend upon the valuation of these assets and liabilities, which are really the balances of the transactions emanating from your related parties. Then all, as I said, all your government entities, government controlled entities, then extractive business, non-extractive, natural resource business, these are the businesses which are otherwise exempt. But they say that a transaction between the exempt business and a non-exempt business of the same person should be on arm's length basis, because otherwise you can have opportunities to transfer profits from an exempt business to a non-exempt business and say that, oh, I don't have to pay tax. So therefore, they've introduced this arm's length provision, even in case of exempt entities, where certain income of the exempt entity is taxable and certain income is not taxable. Then you have this interest on loans from related parties. How much time we have, by the way? I am probably overshooting my time.
Maybe you can consider, Yogesh bhai, maybe 5 minutes or so. You
5
have
minutes. Okay,
5 or 10 minutes you can.
5
or 7 minutes you can.
Very well, very well. So interest on loans from related parties. Here, this particular provision, where you are told that the net interest expenditure, will be allowed only to the extent of 30% of EBITDA. Then you have a provision which says that the interest expenditure on a loan which is obtained directly or indirectly from a related party for certain specified purposes, we will completely disallow you. And what are these? So if I borrow a loan from a related party and pay him interest, but out of that loan, I give dividend to my shareholders, or I do a profit distribution from that amount, then I will not allow you that interest. Secondly, I borrow from a related party and I do a redemption or repurchase of preference shares or a reduction of a capital. Once again, the money coming from a related party at interest and going to some related party in some manner, that interest we will not allow you. Then I have borrowed from a related party and I have done an onward investment in some related party. I have done a capital contribution downward somewhere. again, that interest we will not allow you. Then acquisition of ownership interest into any other entity, we will not allow you. So those interests which have a nexus, I borrow from related party and the money somewhere or the other goes to a related party, those sort of a thing, they are saying that, you look, that borrowing ke upar, whatever interest you give on those borrowings, we are not going to allow you. Now, this disallowance is absolute, even if it is within the arm's length range. Okay, so in these cases, I don't have to see what is the arm's length interest. Irrespective of whatever arm's length or non-arm's length, we will completely disallow you. And to that extent, transfer pricing is not relevant. But a transaction with related parties is. However, there is a caveat there is a fallback over here, which says that, look, I have not done this for the purpose of getting any tax advantage. So there's a very sound commercial reason why I've done this. And if I've done this not for the purpose of getting a tax advantage, then the law says that, all right, in such situation also, we may allow you that interest cost. And they are saying that we will presume that there is no tax disadvantage if the payer of the interest and the recipient of the interest are both people who are taxable at the 9% tax rate, corporate tax rate applicable to them. So there will be a presumption that there is no tax disadvantage. So in such circumstances, you may still be allowed these deductions. Now, this arm's length principle applies not just to the transactions, but it also applies to arrangements. And the arrangement word is wider than the concept of transaction, and therefore it may bring within its fold certain things which we may not even imagine. Like, say, for example, a related party has some arrangement with a third party, okay, under which that third party has to supply certain material to another related party of the group. And therefore, say a holding company mandates its subsidiary company that you buy your computers from XYZ and pay him this much price. Now, so therefore, there is no transaction between two related parties, but my related party is telling me that you buy from XYZ and pay him this much price. If he says so, it is possible that there is certain amount which is being paid to that third party, which is really paid on behalf of my related party. It's quite possible that there is an arrangement whereby certain costs of some related party I am meeting because he is telling me to meet, so I am meeting that cost. That will not be permissible. So it's not a transaction, but it will be an arrangement. And if there's an arrangement which results into erosion of the tax base for the UAE, then that arrangement can also come within the purview of the transfer pricing. Then an interesting part is that you have this no deduction to be allowable in respect of expenditure not incurred for the purpose of taxable person's business. So you have this Article 28, which says that something which you incur for the purpose of your business will be allowed, wholly and exclusively for the purpose of business. Now we will have situations of management fees or management remuneration, which are essentially paid to shareholders or the owners. And these items will certainly have to satisfy the test. First of all, it will have to satisfy the test of it being wholly and exclusively for the purpose of business. A charge against a profit is an expenditure, friends, but a distribution of profits to a shareholder is not an expenditure which is otherwise allowable. It is merely an application of income that you have already earned. It is not a charge of an expenditure against the profit. And therefore, if some management fees or remuneration is paid to your shareholder or to your joint venture partner, then it should first be tested on the footing of whether it is wholly and exclusively for the purpose of business. If the answer is yes, then and only then you go to the next level, whether it is arm's length or not. You have this Article 33(4), which says that if you pay dividend or you pay profit distribution or you pay any benefit of similar nature to the owner, it is not going to be allowed to you. So this is something which will have to be kept in mind in typical transactions which Indian companies and the UAE joint ventures have. are these type of fees which day in and day out comes in our way from the point of view of the transfer pricing. It's very, very important. It's not just transfer pricing, but it is also the concept of for the purpose of business. Now, if you say that that shareholder to whom I'm paying management fees or some remuneration, he had actually rendered services not in his capacity as a shareholder, but if I were to get those services from an outside professional, he would have charged me so much. So he had actually rendered me services. Fine. If he had actually rendered the services, he will be entitled to that fees or remuneration, and therefore it will pass the test of wholly and exclusively for the purpose of business. However, then the second stage comes that because he's a related party or a connected person, it should meet the arm's length criteria. And therefore, you test it from the arm's length perspective over there and then come to a conclusion that it is allowable or not allowable and to what extent it is allowable. And finally, an important thing before I really close transfer pricing here is that here in UAE, you have upward as well as downward adjustment possible in transfer pricing. In India, you don't have that. In India, the transfer pricing adjustment can be done only if it is upward. So if I have earned more profits from my transaction with a related party, there is no adjustment. There is no automatic corresponding adjustment also in the other side. Whereas here, the upward and downward, both adjustments seems to be possible as per the law which is enacted today, unless you find something else coming up in the decrees by the cabinet or by the minister later on. But as per the law today, upward, downward, both are possible. And if both are possible, therefore, you may have situations where the shareholders have provided interest-free funds, shareholders have provided certain services, shareholders have provided certain intangibles for which there are no charges, then probably you may put an arm's length charge and claim that as a legitimate business expenditure. Is a mere sale at a discount covered over here? A mere sale at a discount is not covered. As I explained earlier, that you will have to look at the terms of the payment between taxable persons. You will have to see what are the quantity lifted. You will have to see what are the firm commitments. Am I receiving some commitments in advance which really results in savings in my inventory costs? I may not need marketing efforts when I sell to my related parties, and therefore I'm giving him some discounts. I may not need selling costs. There may be some end of season discounts in certain jurisdictions, geographical differences, market penetration strategies. All these will be relevant. So a mere sale at a discount to a related party is not necessarily going to trigger your transfer pricing. You will have to get into all these factors to see. And another important thing I think is corporate guarantee is fine. And one more aspect which comes in day out are these recharges of common costs. So let me just put the fundamental principle on these recharges before this August audience, that there can be cost-sharing arrangements. Now the question is whether for these cost-sharing arrangements, should those be necessarily with a margin or only on actual cost basis is good enough? For this, there can be several situations. We will not get into it, but let me discuss the fundamental principle that we need to keep in mind while deciding this. Cost-sharing arrangement can be broadly of two categories. One, it may be in the nature of a joint bargain that, look, I as a group am bargaining with a third-party vendor that you provide me with laptops, which will be used for all my entities across the globe. So there's a collective bargain. And in that collective bargain, that person is selling me at a particular price. And therefore, the entity which buys and then distributes to various entities below, he actually charges on an actual cost basis without a markup. So the question arises over there, do I need to have a markup? Because if I were to buy individually, I would have paid more because it's a collective bargain. If it's a collective bargain, then any entity in the group would have got that advantage. It's an advantage of being a collective bargain. And therefore, things like buying hardware, software, things like hiring employees for a common pool, things like buying professional services for a common pool, or things like having a common office space for 2 or 3 companies in the group. So these are the common expenses which may be borne by one entity, but they are as a result of a collective bargain. And here I don't see a need of any markup required in collecting or in actually charging back the cost. You can charge on cost basis. That should be good enough, because that advantage you would have got irrespective of Mr. A and A limited bargaining for it, or B limited bargaining for it, or C limited bargaining for it. It's a collective group as a whole which is really bargaining. So here there is no need of a market. However, if this cost sharing arrangement is on account of certain services which are rendered by one particular entity. So say for example, R&D costs. So one company is doing R&D. One company is providing technical know-how. One company is providing marketing services. One company is providing shared services to the other. So these are in the nature of services which are rendered by one entity, in which case there will be a markup which will be required, and that markup will have to be on an arm's length. So therefore, friends, in deciding as to whether these common costs will require a markup or not, the fundamental principle to be kept in mind is this common expenditure in the nature of a joint bargain, or is it in the nature of service? If it is a joint bargain, no markup required. If it is service, markup is required. And within service, you have services which are low value added services, high value added services. Your OECD commentaries, etc., say that low value added services 5% is a good markup. So many of your your common shared services can go into that particular category, and other services you will have to really benchmark based on the comparable companies and all. So royalties, guarantees, interest-free advances actually are the issues. The last one is general anti-avoidance agreement. Just one word before I take my seat. GAR provision is essentially a provision which says that the taxing authority has a power to ask you why you are doing something, what you are doing. So in India, for many years, we had a concept that I am a businessman. I have a prerogative of doing whatever I want to do. You cannot ask me why I am doing it. So long as it is my business, I can do it. And therefore, so long as it is within my four corners of my business, whatever I do has to be accepted. Tax is only a consequence of what I am doing. However, GAR provision says that no. The tax authority can ask you why you have done what you have done. And in that, answer to that question is, oh, I have done this because I wanted a tax advantage. If that is the answer, you're gone. Then the GAR kicks in, general anti-avoidance rule kicks in, and the tax department will have authority to either ignore the transaction, recharacterize the transaction, or reframe your profits in such a manner that you have not done this transaction, or you have, whatever way in which you have avoided the tax, that has to be ignored. So this is the concept, friends, of GAR. I have quite a few of slides on this. I have what are the experience globally in India and elsewhere in the world. But because of the lack of time, I'm not jumping into it. But I think I have conveyed the key issue. What is GAR? GAR is the authority of the tax department to ask you a question, why you have done what you have done. And the answer should be a good commercial reason and not the tax reason. So whatever you do, whatever arrangements, whatever transactions, whatever reorganization, whatever you do, if it has a good commercial backing, commercial reason, commercial rationale, and tax is only a consequence of what you have done, you are safe. But if you do not have answer to that, then GAR kicks in, and the tax authorities will have power to recompute your taxes. So with this, friends, at the moment I take my seat over to Janak Bhai, and I will probably stop sharing my screen. And then if and when any questions, etc. are there, we will come in once again.